gosh, I can hardly wait. It's time to read about appraisals, which I've already done, and it's really frustrating to me that I probably recorded a lot of this and I'm recording it again for a second time. Nevertheless, it's all learning. It's all good. We're on page 235, so just cruising. The Financial Institutions Reform, Recovery, and Enforcement Act of 1989, FIRA, as I refer to it, required the FFIEC, Federal Financial Institutions Examination Council, banking regulatory agencies to issue regulations to govern real estate appraisal. This law was enacted in response to perceived abuses in the commercial lending system during the 1980s when many banks lost money as a result of lending too much money against real estate that had been overvalued. Congress attempted to remedy the situation by establishing a standard for appraisals used by regulated financial institutions. The agencies issued real estate appraisal regulations to establish a standard for appraisers, the types of loans for which an appraisal is required, and the information that must be contained in an appraisal. In 1994, the federal agencies amended the appraisal regulations to ease some of the restrictive requirements, including raising the threshold on loans requiring appraisals from $100,000 to $250,000. In 2003, the agencies published additional appraisal guidelines that stress the importance of appraiser independence from the influence of both the financial institution and the borrower. In 2006, the Appraisal Standards Board updated its standards and implemented a new scope of work rule. In 2008, Fannie Mae and Freddie Mac entered into an agreement with their regulators, the Federal Housing Finance Agency, to adopt certain appraisal policies. The Home Valuation Code of Conduct for loans made after May 1st, 2009, and the purpose of HVCC is to enhance the independence and accuracy of the appraisal process by prohibiting third parties from influencing the appraisal process. In 2010, the regulatory agencies rescinded the 1994 interagency guidance and issued a new guidance to update the regulations in light of changing economic conditions and the requirements of the Dodd-Frank Wall Street Reform and Consumer Protection Act. Coverage. Appraisals by a state-certified or licensed appraiser are generally required on all transactions involving the sale, lease, purchase, investment in, or exchange of real property, including the financing of such property. The refinancing of real property or an interest in real property, and the use of real property or interest in real property as security for the loan, including investments in mortgage-backed securities. Appraisals by a state-certified or licensed appraisal are not required if the transaction value is $250,000 or less. The lien on real property has been taken as collateral solely out of an abundance of caution. The transaction involves a true lease of real estate. The loan is renewed or extended, or a subsequent transaction occurs, and either no monies other than reasonable closing costs were advanced, or no monies advanced or any monies advanced do not threaten the bank's real estate collateral protection. The bank purchased the loan, participation, or security, and the original maker required an appraisal that met regulatory requirements. 6. The loan is a business purpose loan for $1 million or less and is not dependent on the sale of real estate or rental income derived from real estate as the primary collateral. 7. The loan is wholly or partially insured by a U.S. government agency and meets the appraisal requirements of the insuring agency. And lastly, the loan qualifies for sale to a U.S. government agency or a U.S. government-sponsored entity or Fannie Mae or Freddie Mac. Even if one of the exemptions applies, an appraisal by a state-certified appraiser is required if the loan is $1 million or more, the loan is not secured by residential real property and is for $250,000 or more. The loan is for $250,000 or more is a complex transaction and is secured by residential real property. A loan is complex. The property, form of ownership, or market conditions are atypical. Appraisals by state licensed appraisers. Section B. All appraisers not required to be performed by a state certified appraiser may be performed by a state licensed appraiser. Requirements for appraisal reports. A. Must conform to uniform standards of professional appraisal practice, and B. Must be based on market value. The most probable price that the property should bring in a fair sale in a competitive and open market with the buyer and seller each acting prudently and knowledgeably and with no undue stimulus on the price. This definition assumes that the buyer and seller are typically motivated. 2. Both parties are well informed or well advised and acting in their own best interest. 3. A reasonable time is allowed for open market exposure. 4. Payment represents normal consideration for the property and is not affected by creative financing or sales concessions. And C. They must be written and contain sufficient information and analysis to support the bank's decision to make the loan. So more requirements for appraisals in addition to A, B, and C that I just read here. We've got D, which is you must document the value of the real estate in its existing condition and include appropriate analysis, application, and reporting of deductions and discounts. Now, subpart 3, other appraisal requirements. Use of any in-house appraisers. The bank may use staff appraisers, but they must be independent of the lending, investment, and collection functions. If the only qualified person on staff is one of these functional areas, the bank must take the steps to ensure the appraisals will be independent and adequate. B. Fee appraisers. If a fee appraiser is used, the bank must engage the appraiser directly, and such appraiser may not have any interest, financial or otherwise, in the property. Use of appraisals given to others. A bank may use an appraisal prepared by an appraiser directly engaged by another institution if the appraiser has no direct or indirect interest in the property or transaction, and the bank determines the appraisal conforms to regulation. Appraisal policies. A bank should establish policies regarding the timing and obtaining new appraisals and reviewing, auditing, and monitoring the appraisal process. So those are other appraisal requirements for fee appraisers, for appraisals that were prepared for others, and for and appraisal policies. How could I forget? And the use of in-house appraisers. How could I forget that? Anyway, we're in the enforcement section, and we're 9 minutes into this, Erica. Banks, staff appraisers, and fee appraisers are subject to removal, cease and desist orders, and or civil money penalties for being really messed up. Sorry. or for violation of the appraisal regulations. Zero penalty. They're up to $7,500 per day for violations of laws and regs, penalties of $37,500 per day for violations of unsafe or unsound practices are engaged in recklessly or are part of a pattern of misconduct that causes more than a minimal loss to the bank or any pecuniary gain to the parties involved, and Penalties of up to $1.375 million per day against individuals who knowingly commit a violation and knowingly or recklessly cause a substantial loss to the bank or substantial benefit to the party. Evaluation standards, interagency appraisal and evaluation guidelines issued December 2010. Supervisory policy. The failure to comply with regulatory appraisal requirements or to maintain a safe and sound appraisal program could result in exam criticism or an enforcement action. Board approved appraisal program. An institution's board of directors or designated committee is responsible for adopting a program to comply with the appraisal regulations that provide for appraiser independence, timely receipt of accurate appraisals that support the credit, appraisal review, selection criteria for appraisers, and policies and procedures that ensure that appraisals comply with all of the guidelines. That'd be awesome if it ended there, but it really should go on and on. And I'm not surprised there's a tiny page and it does. C, under, what's the big subsection called? The standards. Okay. So C is where we're talking about the independent appraisal process. Appraisal program must be independent of the lending function, and appraisers must have no direct or indirect financial interest in the property. Furthermore, lenders may not communicate the value they expect, but may ask the appraiser to consider more information or correct factual errors. D. Selection of appraisers. Appraisal programs should establish selection criteria for appraisers to ensure that they have appropriate education experience and hold the proper lease or certification. Engaging appraisers. Institutions must engage appraisers directly using an engagement letter, may use the appraisal ordered by another institution provided certain conditions are met, and the institution should maintain an approved appraisal list. Alright, appraisal standards. Appraisals must conform with the U.S. PAP standards. Although no appraiser may have an interest in the property, the appraisal must contain an opinion and value, and all loans to purchase a consumer's principal dwelling must have an appraisal. 12 minutes. Appraisals must be written and contain sufficient information, analyze and report appropriate deductions and discounts for construction or renovation, be based on a market value as defined by appraisal regulation, be performed by a state licensed or certified appraiser as required by the appraisal regulation, and must establish an appropriate scope of work. Appraisal report. G. They must be appropriate to the risk size and complexity of the transaction, and they must contain sufficient detail to understand the scope of work performed. Evaluation. H. If a loan that is secured by real property is not covered by the appraisal regulation because it is $250,000 or less, the business loan exemption applies or the renewal exemption applies. The bank must make sure that an appropriate evaluation is obtained on the real property collateral. Even though not required by the regulation, the institution should consider obtaining an appraisal, not an evaluation, for the following higher risk types of transactions. Loans with LTVs in excess of the supervisory loan-to-value limits, atypical properties outside the institution's traditional lending market, transactions involving existing loans that are high risk, and borrowers with high risk characteristics. I. Requirements for the evaluation report. Must describe property and its location. Must discuss property's use. Must include the estimate of value and, if used, a discussion of comparable values. 4. Must describe the analysis and supporting information for the property value. And 5. Indicate all sources of values within the appraisal. 6. Must include preparer's calculations if applicable. And 7. Must be written, signed, dated, and contain the preparer's name and address. Where are we at on time? 14 something. I'm gonna shut this down.